In the 40 years that I've been in markets, 30 years of advising clients, it's been obvious that out there, people who are unadvised, especially, but even some of those who are advised, mess it up. And by that, I mean they don't get their investment strategy right, and it costs them millions over a lifetime. Today, I'm going to explore why they mess it up and what you can do to avoid being like most investors. So let's, before we get started, just add everything I talk about on these episodes is general advice. So I don't know your circumstances. So while I design everything to be useful, you should do your own research before you act on anything. So our 5 essential step framework, which you can see here. Where are we in today's topic? We're in the execution, because this is where people take action, and through a lot of their behavioral biases and other things, they actually get it wrong. And there's all these sorts of reasons. And for years, I was looking for a framework and eventually created a framework that I call Mess It Up. And it's just an acronym. So the letters in Mess It Up stand for some of the ways that people mess it up. And developed this in about 2017, where I wanted to be able to explain to people in a simple framework, in a simple structure, what goes wrong with investing, why the returns that most investors get aren't as good as the investments that they invest in. And this has been shown, if we look at the top right-hand screen here, for those of you that can see this, for those of you that can't, let me explain. There's a study called the Delbar study that's been going on for at least 30 years. I think it's about 40 years. They update it every year. You can find the latest copy. The latest copy I have on the screen here is from 2024. So it looks at the return that investors got and the return that investments get. And when I say that quickly, it should be the same thing. But investors don't just buy an investment and sit on it. They chop, they change, they switch. They get in, they get out, they move on. And what that means is they don't necessarily get the results that the investments would have got. So for the equity investors, and equity is just share market. So this is a US study, and it showed for the 30 years to the end of 2023, the S&P 500, so that's the index of the top 500 companies in the US, got a return of 10.15%. Now, you could have got this return if you just bought an index fund and you held it for that whole 30 years. Now, that sounds boring, but it quite clearly got a way better result than the average equity investor. Now, the average equity investor got a return of 8% over that period, so just under 2%. Now, I've seen this range from about 2 to 4% on each year, where the average equity investor underperforms the index. Now, what does that mean in dollars? Well, had someone invested $100,000 back in 1994, if they just invested in the index fund, they would have seen that grow to 1.8 million. So 18 times on a 10% return. The magic of compounding never ceases to amaze me, although I'm not surprised because I've lived it and seen it happen with clients. Compounding at 8%, though, just $1,000,009. So a cost of 808,000 roughly there, by just getting it wrong, by all the things I'm going to talk about. So that's the result. This is how people mess it up. And the letters stand for something. Media. We know the media is fighting for attention more than ever. As the old school media gets dominated by social media, the headlines get louder and louder, and it's all sensationalism. They have one job: to make you read the article, to make you watch the video. We call it clickbait. So, don't let the media be your advisor. I'm going to give you examples of each one of these. We are emotional creatures. We think we're rational when it comes to markets, but my experience has been all of us are not. There's a good podcast I listened to, and I was listening to the podcaster Chris Williamson interview Morgan Housel, who's written 2 books, really good books: The Psychology of Money, which is a massive bestseller and probably one of the best books written on the psychology of money, and another one called The Psychology of Spending. But he quoted in his original book, The Psychology of Money, and like lots of us, we've studied a guy called Daniel Kahneman, who was an award-winning author, and he wrote a book called Thinking Fast and Slow. And it was all about how the behavioral biases that we all make in everyday situations, including with our money. But ironically, Morgan had heard an interview with the late now Daniel Kahneman, where someone asked him, with all of your years of research, and this guy won a Nobel Prize. So with all of your years of research, has it made you a better investor? And he laughed and said, not really. So with everything he knows, sometimes knowledge alone isn't enough. And I don't know the exact details of that, but it's a fascinating story. Then we've got the two S's, and these often go hand in hand: short-term focus and single issue obsessions. And this is where people get obsessed with what's happening right now, obsessed with a single issue. Often they go together clearly. I'm going to talk about these in more detail. And then we've got illiquidity. Liquidity just means the ability to turn your assets into money. And if you don't have enough liquidity, that can force you to have to get out of good assets at a bad time. I'm going to touch on that as well. Timing and selection. Everyone thinks they can time the market. We all act as if we can time the market. The media carries on as if they can time the market, as do active fund managers. I'm going to debunk all of that coming up. And one of the other sources of people messing up is under diversification, where instead of owning the whole market, so in that Delbar example, that's the S&P 500, but someone might have just bought a slither of stocks or one company, and they said, all right, we're just going to go on this one company. So lack of diversification or under diversification as one of the ways there. And lastly, a focus on performance. While performance is important, a focus on trying to outperform is massively misguided. So let's start off with our M and mess it up in media. And this is a headline I've kept. It's an old headline. It's from the Financial Times in the UK. And it said, Britain faces worst recession since 1990s. And I'll read out the first line. Britain faces its deepest recession since the early 1990s. The Bank of England forecast yesterday in its bleakest quarterly inflation report since 1993. Now, what that's and the headline there as well: stocks crushed in 24 billion rush for the exits. Now, these together or separately create this fear. So the media wants you to read, they want you to pay attention. So they get that through fear. In the works of Daniel Kahneman, he showed that fear is a 3 times more powerful motivator than positive sort of news. So if we see a positive headline, we won't read the article. We'll just click on buy. So negative news. But just to show how wrong this gets it, the first headline here, they love the big numbers, 24 billion. So it just sounds huge. Now, to put it in perspective, it's not, it's big, but it's not necessarily that big. But let's have a look at this worst recession. When people think we're going into a recession, they think, oh, I should get out of my shares. But nothing could actually be further than the truth. And we saw this again. Fast forward April 2 in 24 last year, where ABC News and in their headline had Trump's tariffs could cause a recession. Experts say here's how. But let's debunk this right now. Recessions don't necessarily mean the share market's going to go down. Now, they'll coincide with down periods. But let me talk about this. Is the index chart for investors. It's the 2023 version, so it's got results up to 2024. The vertical blue lines here are recessions. Now let's think about recessions, and let me mark some recessions. And when the headlines come out, the definition of a recession is 2 negative quarters of GDP growth. So if the economy doesn't grow for 2 quarters, which is 6 months, then we technically are in a recession. So all of a sudden, when do we know we're in a recession? It's about a month after that. So 7 months into a recession is when the newspapers have those headlines. Now, what happens 7 months into a recession? Let's go back to, 7 months into a recession, I'll go back to the 50s. By the time they announce we're in a recession, we're at the bottom of the market. So the market has already gone down often during a recession. Same thing in the 70s. Same thing, my arrow's out of whack there, but same thing in the 90s. The greatest, we had the recession we had to have in the 90s in Australia, bottom of the market, literally 1 year in. So if all you did was actually buy when a recession was announced, you'd have the same thing. Now, Australia didn't go into recession in the GFC. The rest of the world did. We did not because we had a commodities boom going. But at that stage, once again, if you'd gone and bought shares when the market, when the news announced we were in a recession, you would have been buying it pretty close to the bottom of the market. Whereas those headlines actually make it sound like the market's going to get worse. And keep in mind, when was this? November 13th, 2008. And guess where the bottom of the market was? Pretty much almost exactly that. It was slightly longer. It was January. But if you'd just started buying, and this is so counter-cyclical, but if you'd spent your whole lifetime, every time there was an announcement, not that we might have a recession, but that we're in a recession, because they can't make that announcement until we're literally 7 months in. And if all you did was buy shares like crazy at that stage, you would have made a lot of money. Not the thing you're necessarily going to do, but it's completely the opposite to the pack. I remember back at university days studying the theory of rational markets, and it was based on some premises that investors are rational. Now, 40 years of working in markets with people, I can honestly say I'm yet to meet a rational investor. No matter who you are, and I count myself in this, we're all emotional creatures. Our brain was evolved, from our primitive in the jungle, our caveman brain. You would have heard the terms fight or flight. So our limbic system is designed to keep us out of trouble. So when we heard a rustle in the jungle, could have been a saber-toothed tiger. So our natural instinct was to fight, flight, or freeze. Now let's talk about fight or flight. And while that's a useful emotion, if we're under threat from anything, it doesn't work so much in the share market, and that's because the share market has this tendency to, when things are going bad, the headlines are loud. So that headline I talked about, markets crash, etc. It causes that emotion, and we feel like we've got to do something, and that's because of our limbic brains. We feel threatened, so all of a sudden we feel like we have to do something. And the only thing we can do if we're already in the share market is get out of the market. Now, that's not true, because the other thing we can do is freeze. And freezing is better here, but lots of people end up getting out of the market right when they shouldn't have, because the market goes through this pendulum of fear to FOMO. So the market goes through, and this scribble on my diagram, and I'll describe it for those of you that can't see it, but the market goes through these three main stages of the market. Most of the time, the market's in what we call the wall of worry, where it wobbles up the hill. And if I just go back just to show you back in this index chart, the dark blue line, which is the share market, this goes back to 1950, and you can see most of the time we're going up. Occasionally we stop worrying. So we're in the wall of worry most of the time where we're wobbling up the hill. Occasionally we stop worrying, we have a boom. It's followed by a bust. The boom and the bust are the irrational bit. The wall of worry is the normal bit. So I go back to my little scribble. And during the wall of worry, the market ranges from expensive to fair to cheap. And they're opinions. It doesn't tell us what's going to happen next, but it's just a measurement. But in the irrational bit, which is the boom and the bust, it's where we've had lots of good news, so we stop worrying. So the market gets ahead of itself. It keeps going. And this happens every single time. And I'll talk about some more of these. But when things are going well, we have this boom. And another word for the boom is FOMO. And what's FOMO stand for? Most of you will know, but it's fear of missing out. So it's actually fear. It's fear and fear. So the emotion of fear, once again, 3 times more powerful than positive emotion, drives our behavior. So we go from fear to FOMO, and even when we're in the wall of worry, all these little dips of fear of this and fear of that. So fear drives us, and the markets aren't a zero-sum game. Gravity is not flat. Gravity is an increase of 11% over the last 80 years. That's the normal. So it's not like it's a flat line. If we're out of the market, we're missing that going up. So emotions. And one of my favorite quotes in the share market is Warren Buffett, the consummate investor. And he says, be fearful when others are greedy, and greedy only when others are fearful. So what he's saying there is right when the markets are at their bottom, when fear is at its highest, is exactly when you should be greedy and buying the market. Now, some people do that, but that's not what most people do. Most people either panic or they freeze. Freeze is okay. Markets will come back. But the panic and sell, the panic and switch, My good friend, Dr. Mark Brimble at Griffith University, has done numerous studies on super fund switching, and it shows quite clearly that every time there's a major downturn, people switch more frequently, and they're not switching into shares, they're switching out of shares, they're switching from higher growth options to more cautious options. What do they do when the fear passes? They get back in. So it means they've locked in losses. So let's move on to the first of the S's, and these two do go hand in hand, but a short-term focus. And I found another headline. Headlines are a great way of illustrating this, as well as stories of what people have done. But the headline here from USA Today was stocks drop after Russia starts invasion of Ukraine. Here's how to manage your stocks during the crisis. It goes on to say Russia's invasion of Ukraine is triggering a drop in stock prices, but now may not be the best time to go on a stock shopping spree. That's because prices may slide even further amid a heightened state of uncertainty, says Eric Friedman, the chief investment officer at US Bank. Now, this article is fascinating for a few reasons. One, you read chief investment officer of a US bank and you think this guy's got to know, got to have it all worked out. But let's have a look at the chart here. Right about when he was publishing this at the back end of February, if you did the opposite of what he said, instead of avoiding buying stocks, if you bought like crazy, in the next 3 years, you've almost doubled your money. The market dropped to about 3,500. It's almost 7,000 at the moment. So in spite of that war still going on, so if you'd waited for the war to resolve, you would have missed out on doubling your money. So that short-term focus, and whether it's whether it's this, whether it's Y2K, or whether it's whatever event it is, and part of the reason is because the market's very quick at pricing it in. And as I talk to my clients, just because the world's at war, or not the world at war, part of the world's at war, it doesn't change us using our iPhones. It doesn't change us going to Coles or Woolies and buying our groceries. It doesn't change all of our day-to-day activity, browsing on Google, scrolling on Facebook. So we continue to make money for all these companies. Now, in fact, in a war, more money will be spent on guns, ammunitions, and all this stuff, which actually creates profits for those companies. Post the war, there's rebuilds, which creates activity, which is profitable to companies. There's always a drop at the start of a war, but it always bounces back. There's always lots of other things going on as well. But that short-term focus, immensely profitable, immensely unprofitable. Single issue focus, and I used to have a different slide for this, but the number one single issue in the last 8 years or so has been Trump. I'm going to offer no opinion except that he is, I've never seen a more polarizing figure, and I've never seen more people say that, oh, I'm a bit scared of what's going to happen on the investment front with all the Trump stuff. And once again, time passes on. We keep buying, we keep doing all our stuff, and that's good for shares. But I'll tell a story. Back before Trump won, so Trump was elected back in 2020, in 2020, what are we in? We're in 26 election years, 24 and 20. Yeah. So as he was elected, so we had this fear, and I had one client ring me up and say, Rob, I think Trump's going to get in, and I think the stock market's going to crash. And that seemed like a rational, this guy is very rational. It seemed like a rational response. But what happened when Trump actually got in? The market jumped. It had a melt up. It actually jumped 10 to 15% in the next month or two as the market got excited about Trump's potential spending, about his potential helping of market forces. So the fear was unfounded. And that single issue focus is still around. Other single issue focuses that I've seen over time, some of you will remember the year 2000 or the Y2K bug, where everyone obsessed about what might happen when the clock ticked over from December 31, 1999 to 2000. All the computers in the world might have failed, and there was predictions, everything from stock market crashes to everything else. What happened? Precisely nothing. The stock market kept going up. It was actually in a boom, the dot-com boom, which I'll talk about in a minute. And once again, this obsession with thinking that just because we see some news, that's going to affect what happens in the share market. News comes out, stock market response is instant. And the news is just one thing going on. Warren Buffett also once famously said, in the long run, the stock market's a weighing machine, but in the short run, it's a popularity contest. So his other thing was that the stock market is a bit manic depressive or bipolar in that it reacts overly badly to bad news and it underweights good news over time. So let's move on to illiquidity. So illiquidity just means we don't have liquidity. And we're investing in the share market. It's been my observation. And I got this from one of my investment gurus, a guy who's now in his 90s, but who I helped firm my investment philosophies 30 years ago, a guy called Nick Murray. But he pointed out there's only three ways you actually lose money in the share market. One is to panic and sell when the market's down. The other is to have to sell when the market's down, and the other is to be not properly diversified. So if you never panic and sell, and if you never have to sell because you've got reserves, which is always part of our investment process, and you are truly diversified, and keep in mind the ultimate diversification is to own the market through index funds, you win. You can't help but win in the long run. So we see again that index chart, the line goes up. If we don't panic, if we don't get it wrong during the boom and bust, we win. How do we do that? We use a liquidity bucket strategy where we have income, we have a pool of safe investments. We pay our income from that pool. We top it up all the time, except when markets are down, where we just draw on that pool. And I won't go into that fully, but it's part of our investment philosophy that we use. That means our clients have never had to sell when the market's down. We've got a pretty good track record over the years of thousands of clients having been through our business. And there's only one that has panicked during that time. The bottom of GFC, I won't use his real name, but I'll just call him Tony. Tony was ringing me every day. And he was worried that the market was going to keep going down and it was going to get wiped out completely. And eventually I said, you're clearly worried. And we'd written articles, we'd published stuff, we'd sent out all this news to say, exactly the types of stuff I'm talking today. The only action from here is to hang on. Had we been able to predict it? Yeah. And this is 2007 where the market had gone down and down and down. Anyway, we just agreed that because of his literal worrying and his mental health, he needed to get out. But I said, you have to promise me this. You can never get back in. He said, oh no, you can tell me when to get back in. And I said, no, I can't. I'm telling you not to get out because I won't know when this is over. And here's what most people do. They panic right at the bottom of the market. And during these big booms, there's almost always a rebound as people realize we've over panicked and the market bounces anywhere from 20 to 50% within a year. So after all these booms, there's massive, you'd see, and I'll describe them here, but in the 70s when we had a drop of 50%, the next year was a plus 50%. Post GFC, the market actually jumped 50% in the next 12 months. Post 1987, there was a 20% and 50% over 2 years. So these rebounds are strong. Now, what did Tony do? He moved out. He put into term deposits. At the time, he could get about 7% on a term deposit. It felt safe. But 3 years later, when he came out of that term deposit, the market had jumped 60%. So while he got a 24%, he missed out on that. This is why he can never come back unless he could promise that he would never panic again. Now, I lost track of him. I don't know what he did first that time, but it's a classic story of locking in a loss right when you shouldn't. Everyone thinks they can time the market, but no one can. Warren Buffett, the world's greatest investor, and I say investor carefully and not speculator. Speculators chase little bets all the time, but Warren Buffett does not attempt to time the market. Now, he reacts to the market. So if he thinks the market's cheap, he will buy more. If he thinks the market's expensive, he might trim some of his positions. But he's not timing the market. He's just looking to see what price the market is offering. And depending on that price, he might then act accordingly. Now, that's very different from timing the market. Now, to prove this, in 2007, while the market was still booming, he entered $1 million bet with a fund manager called Protege Partners. Protege Partners were hedge fund managers, so they managed a basket of hedge funds. He let them pick any combination of hedge funds they like, so they picked their best hedge funds. And part of this was because Warren knew that these guys, he was being critical of them because they charge a 2% management fee and they charge 20% success fees of any profits above an index or a cash rate, depending on how they're structured. So what happened? Yeah. So, and I followed this during the time, year by year, but at the end result, 10 years later, they actually waved the flag. They gave it up before it was over. But the end result was the S&P 500, despite going through the GFC at the start of that, still had a 7.1% return over 10 years. The hedge funds, so the best of the best, these guys get paid literally fortunes, had an average increase of 2.2% a year. That's a 5% difference, 4.9 to be precise, but that's a 5% difference. When you're compounding at a 5% difference, it's millions and millions over your lifetime. So even the best get this wrong. And the best way to not make mistakes around timing the market is not to time the market. There may be times where you react a little bit like Warren, and these are some of the more advanced things that I'll talk about in other episodes. But there's ways you can top up your reserves a bit more if the market's running hot. But you never exit the market or never attempt to trade the market because it just doesn't work. And then we've got under diversification. So this is where instead of investing in the broad market, say the index, we get all obsessed, often about a single issue, and then we say, I'm only going to invest in, let's say, technology. So during the 90s, we had this NASDAQ, which is a great measure of technology. The NASDAQ index went on a tear. And from 1994, well, actually from 1996, where the index was 1,000, it would go up and it peaked in 2000 at 5,000. Think about that for a minute. The index went up 5 times. Now that's like, the S&P 500, sorry, let me go to Australia. The ASX 200 at the moment is about 9,000. Let's say a few years ago it was 6,000. For it to be in a true bubble like this one, to go up 5 times, it would have gone from 6 to 12 to 24 to 48 to 96 to 192,000. Now that just sounds ludicrous, but that's exactly what so it went up 5 times. Let me rephrase that. It wasn't 5 doubles, it went up 5 times. So that would be from 6,000 to 30,000. So 6,000 to 30,000. If the ASX 200 is at 30,000 right now, I would actually be agreeing we'd be in a bubble. But at $9,000, it's just in a good, solid market. And they're very different because bubble's an emotional word. People fear, they back to the emotions, then they fear they've got to get out of it. So in this case, what happened? And what happened was what happens in any true bubble. The cause of that bubble goes down, and it actually went all the way back down to close to 1,000. So it went down about 80%. Some stocks in that area went down 90% to 100%. They went broke. Now during that time, the S&P 500, so the broader index, went down 50%, but the narrow bit went down 80%, and even narrower if you picked the wrong companies. Some of them went broke. Some of you may remember the company BlackBerry, but BlackBerry would eventually go down 95% as the iPhone came into being. So that focus on trying to get those bets right or under diversification causes people to lose a lot of money. Now, let me talk about the maths of investing. When you lose 10%, so when your investment goes from 100 down to 90, you need about a 12% return to get back to 100. When you lose 20%, so when your investment goes from 100 to 80, you need a 25% return to get back to 100. If you lose 50%, you need 100% to get back to 100. Now, if you lose 80 or 90%, you're not coming back. You can't physically get there through investing short of 50 years. So you wipe out. And of course, what you were doing when you were under diversifying was speculating the one thing run hot. Now, it wasn't just the dot-com boom. I've seen it with rare earths. I'm seeing it with gold right now, where people see these results. They're looking in the rear vision mirror. They see a result and they go, I'm going to get that. They go, we're only getting 10, 15, 20% in the broader share market. This .com, this NASDAQ index has been getting, 100% per annum. I want some of that. And in they go, usually just before the peak of the market. So one of the most expensive ones completely. And I'm going to say almost the biggest one, but when combined with the others, they're all exaggerated. And then we'll look at performance, a focus on performance. Now, In my 40 years investments, 30 years advising people, in my early years, I thought it was possible to pick funds that would outperform the market. But as the statistics clearly show, it's it's possible, but it's highly improbable. Let me talk you through it. So this chart shows the number of funds that outperform the market. And you can see it ranges from a low of 45 to a high of 87 over the last 23 years or so. Now that's all right. There's yeah, let's say 60% of the funds are outperforming the market. That's good. That's for 1 year. So let's have a look at dive deeper in that research. And I've got some research on the screen here for those of you that can see it up to June 23. For those of you that can't see it, I'm going to talk it through. And I'm going to focus on US large caps. But over 1 year, 60% beat the manager. For Aussies, it was 76. Go over 3 years, 80% beat the managers. 80% beat the benchmark, I should say. So the index, 70% in Australia. Go to 5 years, and these are 86%. And once again, I'm actually getting the numbers backwards here because it's so staggering. 60% underperforming, 80% underperforming, 86% underperforming. Over 15 years, 92% underperforming. In Australia, 85%. So let's call that only 8% outperforming over that period of time. 8%. Now, I don't not believe that there are some managers that can outperform. I just know that it's very hard for them to do it all the time and over the long time. And I know the chances of us finding them in advance is 8% because a number of reasons, but the ones we're going to look at are probably going to be the ones that outperformed last year, and they're not always the ones that outperform the next year. And this chart goes to that. So if we look at the number of funds, and this is US, 488 funds, and the top quartile is the top 25%. So they took the top 25% from 2020, and that was a volatile year that included COVID. Look to the next year, only 4% of all those funds remained in the top quartile. 4%, and then the next year, none. So if we'd been looking in the rear vision mirror and we picked the top quartile funds across any of these, none of them would have been in the top quartile 2 years later. This is extremely hard to do, which is why we just don't bother. And we much prefer to be indexed and get the market return and be long-term holders. So, and once again, in Australia, slightly better results because in the US it was zero, except for small cap funds. In Australia, we're down to 2%, 6% of funds that were still in the top quartile. Once again, almost impossible. But when I say percentages, so if I say only 8% of funds are going to outperform over 10 to 15 years, and there's different stats, but let's just say it's 8%. Let me line that up with something we might be able to relate to. And most of you will know how to play blackjack or 21. The idea is to get to 21. If you go over 21, you bust. And you can play it at casinos or at home. But let's say you've got two cards totaling 20, and let's say you're not going to split them, and you've got one choice. Do you stand or do you hit? And I've run seminars for the last 20 years, and every audience I've asked, 100% of people say they would stand. Why? Because it seems silly to go for one card, the ace, which would allow you to improve your hand and not bust. So what are the odds of getting an ace? Well, there's 4 aces in a pack. There's 52 cards, so you got 1 in 26. So 8% is the odds. So the odds of hitting an ace is 8%. What do? We don't take those odds. But what does everyone do in the investment markets? They take those odds. They try and pick funds that are going to outperform with almost no chance of doing it over the long run, even over the short run, even over those 2 years. It's incredibly hard. So they're the reasons that people mess it up. And you can see that again there. The mess it up is just an acronym. It's useful for catching yourself out. And if you're trying to do those things, and have a look at those returns again. If you just held the market over that last 30 years, 10%, and that wasn't exactly a cruisy 30 years. We've had all sorts of trouble during that time, from COVID, from the dot-com bubble, from the recession we had to have in Australia. So, and it still spat out 10%. Right now, the long-term equity markets in Australia are about 10%. So you can get good returns from index, and that's my main focus from today. So hopefully this helped. And until next time, Rob McGregor signing out.